Hey, super happy to be here today again. But this time we're super duper excited because we have Daniel. I know Daniel for a long period of time right now, and I'm super excited to have you here on today's podcast. Danny, thanks for being here, and I would love if you can tell the audience a little bit about yourself and who you are.
I'd like to start by
Cool.
asking the question, what is your story?
Yeah, sure. My name is Daniel Haas. I work in the financial markets since the early 1990s. I started working for a Saudi Arabian spin-off from the Sovereign Wealth Fund in London, and I worked there mainly in the kind of analysis, not back office, but more kind of support role back in the early 90s after I finished my law degree. And I was connected to the equity trading division. And I decided in 1994 that I wanted to make Aliyah. So I approached the markets division of Bank Hapoalim in Tel Aviv, and I said to them, I'm a Zionist and I want to come and live in Israel, and I'm looking for a job before I come. And so they said, yeah, cool, come for an interview. So I flew out literally a week later for an interview. And obviously we hit it off, and they decided they want to give me a job. And I started my first proper trading job as an FX, a foreign exchange trader in non-shekel. At the time, they didn't use G10. It was mainly the majors, so dollar mark. This is pre-euro. Dollar mark, dollar yen, sterling, and then a lot of the other kind of legacy European currencies, French franc, etc., etc. And I was an FX trader for approximately 10 years. And then I moved back on behalf of the bank to London to run their sales operation in London, in Hapoalim in London. It's a pretty small business, but it's with their clients in the UK, in particular institutional clients in the UK, some small hedge funds. And I stayed there for 2 years. And in approximately 2005, I moved back to Israel. And I was asked to come back to the trading room, but work with more so also with the trading, but also dealing within the trading department with the bank's international clients, obviously because of my ability to speak English and my experience. So I was working, kind of talking about the Israeli markets, facing international banks, a lot more banks back in the day than there is now. And slowly, I moved towards the sales or client-facing role, less so in the trading. And I worked with institutional clients like hedge funds and sovereign wealth funds. And about 5-6 years ago, I also still trading, and still client-facing, but I started doing more strategy and helping build strategy, market strategy for our offshore clients. And again, we have considerable number around the world, in Asia and obviously in the UK, and also some in America, but less so. And our main focus is domestic markets. So it's basically kind of summarizing. I work with portfolio managers in UK, in Asia and Singapore particularly, to help build an understanding and then obviously to execute on their behalf over-the-counter strategies in FX and in rates, FX derivatives as well, and rates, interest rate derivatives, so swaps, sometimes in kind of in bonds as well, in fixed income. But fundamentally, it's a macro-based theory, and the traders that I'm working with on the other side of the fence are macro traders, usually directional, but also some relative value guys. And that is in a long nutshell, that is what I do for a living. I basically am an expert after almost 30 years in the Israeli shekel markets, in predominantly OTC products.
That's a really comprehensive career. That's a really comprehensive background, especially in the banking and the trading industry. And I would like to start from the end of your career, from like um, over the counter is an asset that only the banks and the big institutions are get exposed or get exposure to. And I would like to ask you about literally about OTC. What's an OTC? How derivatives, how FX derivatives work, how the entire market works, and how you approach that market, especially when you're a highly experienced trader, and actually making a profit out of it, and
Okay.
how everything works under a big institution like a bank, and not from the
Okay.
perspective of an individual trader.
Okay. So first of all, going back to what you said, it's not my end of my career yet. I'm at hopefully just the middle. I have no plans to retire, so I'm not quite at the end of my career, but very experienced, correct. OTC, over the counter, is a term used to differentiate products or asset classes which are not listed on an exchange. So a bond and equity are exchange listed, and over the counter is usually off balance sheet products. So it's foreign exchange, it's it's interest rate derivatives, like I said, and it's more bespoke as opposed to an asset which is listed. Again, a bond, an equity, a future, they're listed on an exchange, they're exchange traded. My business, or majority of my business, so it's not exclusive, is done with these kind of individual trades which are very specific. So FX could be for a specific period of time. An interest rate swap can be on various periods, but it's individually designed and it's not listed. So you don't have a price of an interest rate swap listed on any exchange in Chicago or London, what have you, as opposed to a future, which is listed price, and you have a screen and you can see individual futures or whatever. So that's OTC. It's more kind of like, but it's more bespoke as opposed to a listed security.
And
As far as
derivatives.
comparing, say,
How
a bank.
volatile the OTC market is, because if it's like beyond the exchange, beyond the regular exchange, how volatile the asset is, and how the actual big institutions trade and move the
Okay.
markets
Okay.
within
So
OTC assets.
again, I mean, FX is fundamentally a very generally a fairly volatile asset class because of the flow. The biggest market flow of any asset class in the world is foreign exchange, because it's the most obviously used and utilized. Everyone, travels and companies do business. So by definition, there is a huge global turnover, daily turnover in the trillions of dollars in the FX market. Volatility in FX is derived from many factors. There's obviously interest rate differentials and speculation. By the way, FX market is the most speculated market in the world as well. But it's very simple. Because of what it is, people have an opinion, a relative value opinion, or I think euro will go up or dollar will go down or whatever. So there's a lot of activity in these kind of major crosses. And also in emerging markets and developing markets, frontier markets. But the bottom line is that volatility is obviously a derivative, as I said, of very many factors. There's macroeconomic factors, there's trade factors, there's geopolitical factors, as we see now in Israel. Many elements of our lives, not just economic fundamentals, but also it could be, the structure of what's going on as far as platform and AI. All these kind of new technologies are, I think, a lot of them are being tried and tested on the foreign exchange market because of the liquidity, because of the accessibility. So all these things are very relevant as far as volatility. But I want to go back to what you asked about the differential between say, working in a bank or a private individual. Fundamentally, a bank is a retail business. So most banks, you can take away like the kind of big American investment banks, but the vast majority of global banks, the business they run is against clients. So it's against retail clients, people who have bank accounts. It's against people who have businesses. So, a guy who's exporting and importing is a client of a bank's risk manager or risk department, treasury department like us. So when you work in a bank, you're first and foremost, you're there to trade with your clients. And within doing that, you may have some kind of mandate to take positions in particular asset classes. So people who trade foreign exchange in a retail bank, which again is the vast majority of banks in the world, his prime rationale for his business is to provide liquidity to his clients. Now, in doing that, he may also, and in vast majority of banks, the traders trading foreign exchange, for instance, and it will be different on different asset classes, but the traders trading foreign exchange, for example, will have to have positions on all the time. That means they'll be exposed to market volatility all the time, because if they basically, you can't run a foreign exchange book by just, constantly taking every single position that you receive, every single trade you receive, and then covering it. So if someone sells you 5 million euros, you go into the market and sell 5 million euros. It just wouldn't work. You'd lose money because of spread, because of volatility. It just wouldn't function. So every single trader I ever knew in the foreign exchange market will have to make sure that at any given moment, he has an opinion of where the market should be going in the next, and obviously different markets, depending on volatility, the horizons are much shorter. So foreign exchange, you're trading for 10 minutes, 20 minutes, you may have a medium-term horizon, but on the whole, you're looking very short-term, and you will hold positions which could make or lose money in the very short term based on an opinion. And then as clients come and ask you for prices, you may add to the position you've already got, or it may actually reduce your position, but you're continually adjusting the position. And obviously the more you do stuff, it may mean that your positions, obviously the bigger the bank, the bigger the positions, different nuances as far as time frames, attitudes to stop losing money relative to making money. All these things are very relative. Different asset classes, for instance, in the fixed income world, like FX derivatives, you'll have a different set of nuances. But and again, when you go over to the rates market, swaps, relative to bonds, different kind. Fundamentally, by the way, all the OTC asset classes I can think of will have to be very, very aligned with global macro stories, interest rate differentials, Fed policy, etc., etc.
So, wow, you have literally provided with the perfect outline of how the FX market works. So, I would like to dive deeper. In your perspective, how can I, as an individual, make money out of the foreign exchange markets, and especially, you know what? Let's talk this conversation about the fundamentals. All right. Speaking of the euro dollar, all right. Let's focus our entire focus of the conversation on the euro dollar, and let's speak about that asset in terms of its fundamental approaches. So, how do you approach fundamentally a foreign exchange asset, and how would you try to learn and absorb more of its fundamental information in order to know how to trade it properly and how to time the market, especially in hard times, that you already know how to get properly prepared in advance. I think that's a major challenge. Being
Well, hold
properly
on a
prepared
minute. I
fundamentally.
think, one sec. First of all, going back to what you said, how you trade
Yeah.
foreign exchange in a bank is completely different. You're not a speculator. You're taking a position, a speculative view, because of where you see flow coming, demand, because you're a market maker. Now, as an individual who wants to make money in the foreign exchange market as a participant, but who is on the other side, who is taking a position based on a belief that they can understand direction is a different story. So if you're in a bank or an investment house or portfolio manager, again, different ways of looking at it. Everyone will look at the macro criteria. So again, interest rate differentials, global stories, central bank expectations, bond markets, equity markets. I'll give you an example. Obviously that's my area of expertise is shekel. So the Israeli shekel has several factors which are very unique to the Israeli shekel, which would determine whether it goes higher or lower. Clearly, we're at war and we have elements of geopolitical risk which affect the shekel. We also have the behavior of the biggest participants, which is in Israel, it's the pension funds, the real money community, like the pension funds, the insurance companies. Their attitude towards the shekel is fundamental on direction. And I mentioned this. So as a bank trader, you will know these factors. As an individual, you will have to understand these factors, but you may not look at it that way because you're looking at direction. Okay. Now, if you're sitting in a bank and you're getting a phone call from a pension fund who's wanting to sell you $100 million against shekel, remember, foreign exchange is called exchange for a reason because all you're doing is taking one currency and swapping it for another currency. So you are actually doing a direction, but also a relative value. What do you think is more valuable in the medium term or in the short term? So within the FX market, if you're sitting at home and you're wanting to trade dollar shekel or euro dollar, you may think, okay, I have a more broader vision of what should be the case. The market for a dollar shekel could be 365, or the price of euro against dollar could be X or what have you. And I think it's undervalued or overvalued for the various reasons. And as a participant who's not sitting in a market making shop like a bank, you're free to choose and go with a direction. So you buy an asset, i.e. either the dollar or the shekel, and you expect that asset to gain against the other currency. And you'll make a decision based on that, and you may set yourself a target where you think it should trade to. As a bank, it's different. As a market maker, it's different. Why? Because at any given moment, someone may come along and reverse the position you're in. If you're sitting on a position of, say, I'm long $20 million against shekel, and along comes an insurance company and sells you another 20, you're now long $40 million. So your perspective on where you should price and where you see things is influenced by your position just as much as the global story. So it's a big difference between, and you alluded to it before, saying, well, how does it change if you're sitting in a bank or a private individual? It changes massively. The guy sitting, a portfolio manager in a hedge fund, will be more like a guy sitting at home. So he may have access to more information and be more experienced and be able to kind of structure his way, which is more beneficial to him than the average layman sitting at home. But again, it'll be very different to what a guy sitting as a market maker in a bank will be looking at, how he will judge his positioning. Okay, he will have a certain set of clients, a specific type of client, which may be different to, say, a corporate. So a corporate client could be very different to an institutional client. A hedge fund client could be also very, very different. So in general, I think there are certain things which are relevant to all, whoever trades macro, and I'm an expert in macro, which is, underlying asset classes, fixed income, is that we look at economic fundamentals. We'll have an opinion how there's going to be a lot of variable factors.
Daniel, I would like to ask you a question. I don't think that most of the audience will know what a fixed income is. So if you'll be able to provide us with a little description about what a fixed income is, and would love to continue. And by the way, I would love to answer another question to the topic of that conversation, and I would like to ask you, in your perspective, how it's like being in a place where you get along so many customers each and every single time you meet them. And I would just want you to describe how this entire issue works, how the bank sells his products to institutions, hedge fund. Of course, speak about only what you're able to speak like speak about what you're able to speak. But I just want to educate the audience, especially.
Okay, so the fixed income, I don't think your listeners really need to know a definition. It's a very simple definition. It's fixed income coupons, things like that. But it's basically a generic term now used to describe markets, non-equity, for instance, where you basically FX, foreign exchange, interest rate derivatives. That's all with it. Bond trading, government bonds, sovereign debt. That is fixed income. You know, you have also credit markets, which is like corporate debt. You have equity markets. So I don't think for your benefit of your listeners or your subscribers, whatever, that you need to know a specific. They can Google the exact definition of fixed income, and I'm sure on Wikipedia it is very clear. Remind me your second question.
So the second question was, how do you, as a migrant maker, makes deals with clients,
Okay.
big institutions, hedge
Okay.
funds?
So
How it looks
you
like? Please
mentioned about
describe the
our
process.
products. As a bank, okay, again, unless in fixed income, you're selling very specific assets. You're buying and selling, you're trading in very specific assets. Assets meaning product, you call them products, but I prefer calling them asset classes, meaning foreign exchange. They're not our products per se. What we're doing is facilitating access or liquidity for corporates, for institutional clients like pension funds, for private individuals. We provide them with the liquidity. Someone wants to take a position in the market. Someone has some kind of functional need to buy dollars because he's got to buy products from America and he's going to sell me shekel and buy the dollars. Very similar to a lot when you go to the airport to buy your currency. When you're going to Thailand, you'll go and ask them to sell you some Thai baht. Or if you go to Europe, you'll buy some euros. We facilitate that process. As a market maker, you will provide a price. The same way if you go to a bureau de change at the airport, they will tell you, you can buy Thai baht at this price and you can sell Thai baht at that price. And that difference, the bid offer or bid ask, in some cases, some people use that term, is where banks on the whole make their money. However, the reality of life is that banks, as I mentioned just now, cannot buy and sell on a kind of, it's not symmetrical, it's not hermetic. So banks tend to hold big amounts of various currencies based on an opinion about where the market is going, and they can see where the demand for a particular currency is likely to go based on strategy. This is where I come in. And so they will say, oh, we have a preference to hold dollars over shekels. And because we believe that the market is going to be demanding more dollars in the coming days because of all the outlying factors I mentioned. Vice versa, also possible. So we will have a strategic view. Clients will have a strategic view. And so what the bank does, or what a bank does, is offer the ability, the accessibility for corporates, again, institutional, private individuals, to access the availability of these particular asset classes. Maybe a client wants to buy bonds. Maybe the client wants to take a position in interest rate swaps because it's off balance sheet and it's less capital intensive than bonds. Maybe he has a need, he has a view about ongoing geopolitical crisis in Israel, and so he wants to buy dollars to protect himself. He wants to hedge his positions using fixed income asset classes, like I mentioned. But bottom line is, I speak from the world of I provide liquidity. I also take it because obviously if I receive a lot of dollars from clients, I may want to sell some of those dollars. So I go to the market and I go and seek a potential buyer, an offset or hedge my positions by selling my position onto someone else. That is how you get a market of several $1 trillion on a daily basis. Is, you know, the circular movement of currencies and interest rate risk. People are offsetting, and obviously markets are moving constantly. And as people have an opinion, you may see demand for a particular interest rate or particular tenor on the interest rate curve change and grow or diminish, and that is what impacts markets. But as far as a bank, our attitude is very different, as I said, from a individual or a speculative organization like a hedge fund, who is always looking to see where there may be discrepancies or some arbitrage in the market. That's not the world of a bank. Our job is to manage that risk, provide the liquidity to clients, and move on.
Wow. Wow. All right. So now I would like to take you a little bit back within your experience in trading, back to your trading, back to your time at a trading desk. Um, how like how would you approach a trading desk today? What would be your main criteria of workload that you need to do in order to manage a trading desk? And how would you define a successful trading desk? And who needs to participate within a successful trading desk in order for its successfulness?
So a successful trading desk in a bank can be defined as profitable, keeping your risk profile as low as possible. You don't, an example of that, you don't want to be in a situation where every day you're losing $1 million and at the end of the day you make $5,000, but you've been as low as minus 100,000. So your risk profile is very skewed or very asymmetrical. That's not good. So it's good management of a desk. I would say from my time as a trader, I have to be absolutely clued in on all the various parameters which have an impact, from economics, macro stories, interest rate, monetary policy, fiscal policy of the markets I trade. Obviously, we have systems like Bloomberg media systems, information systems provide us constant information updates and understanding how individual pieces of news may impact. And also, each piece of news isn't, let's say, there isn't a certain kind, there is no, every single piece of news is equal to 1 or equal to 2. The weightings for different kinds of news will be very, very different. And it will be, again, very different depending on other circumstances. So you have to be constantly understanding how individual pieces of news, whether it be economic data news or wider sense political news, how at that particular moment, or based on a general kind of metric state of circumstances, how it could possibly impact. Different news, as I said, will have a different weighting at different times. And so there's all these variable atoms running around creating chaos. So a good trader will have to know when to discount pieces of information when it's less relevant or possibly diluted by other events, or in some cases irrelevant because certain other factors in the particular story are far more important at any given time. So I'll give you an example to make it easier. So historically, when the NASDAQ goes higher, the Israeli shekel also goes higher because of the likely influence of foreign direct investment into Israel, which is very much correlated to the NASDAQ historically. So you see NASDAQ goes down, up, dollar shekel would historically go down because of the level of, the level of investment. Local institutions have grown their participation levels in US equity markets so dramatically over the years. And obviously, as NASDAQ performs, so the dollars they're receiving as a performance grow. And so they hedge it and they sell dollars against that. So what you found historically, that made a massive impact in the market. NASDAQ goes higher, dollar shekel goes lower. But if you look what's happened in the last year and a half, okay, NASDAQ has performed very well last year, and this year it's up 20% almost. And yet dollar shekel doesn't go down because of the geopolitical, because of the circumstances. So we've learned, and this is on the simplest level, a very simple example. We've learned that even though there is still this huge correlation to NASDAQ, it's taken a back seat because other factors are far more important at this particular time. The obvious case is that there is a certain sense of reluctance to sell dollars, even if Nasdaq's going higher, because you fear the geopolitical, let's say, effects of the war. And obviously, if people are very concerned about the state of the geopolitical in Israel, they probably will buy dollars and sell shekel in order as a kind of reaction to that. So as a trader, you'd have to say, okay, what's more important at any given time? At this point, it's better to be less inclined to sell dollars despite what's happening in the US equities because of the geopolitical. That kind of trumps the importance of the kind of correlation, historical correlation to US equity markets. So that's one example. There are a ton of stories. When you're an FX trader, your attention is in multiple places at any given time. That will be different with different asset classes. You know, when you're trading interest rate swaps, you look at the underlying bond market, you'll look at some macro, but you're less, because the volatility in those markets is far less. So you're less concerned about, you know, very small issues. So you have more of a kind of contained, more defined set of parameters you may look at. But most traders that I know are the good traders have a couple of qualities. One, they're brave, because you have to be it's very hard if you're losing money to sit there and say, oh, I've got conviction to keep this because I believe it's going to rebound. Two, they have a great understanding of the world economic affairs. And three, there is the special source, which is certain things which certain personalities have this ability to kind of read certain scenarios and react to it.
I got it. I got it. That was an interesting insight.
How many parameters are involved when you weigh in the news? How many parameters could be involved? How many parameters could be involved when you weigh in the news?
Yeah, well, it could be one. You know, sometimes it's one because it's so overwhelmingly important that you could have one parameter suggesting to buy dollars and 10 parameters suggesting you should sell dollars, but you'll stick with the one because your opinion is that this basically more important than all the other parameters put together. A normal country, and I'm not talking about Israel, you'll have varying changes. But that's why you see things like FX, for instance, move constantly. It's constantly shifting backwards and forwards like a tide. And what's causing it? Demand, obviously supply demand, but there's other individual certain nuances on different markets, which as a trader in those markets, a specialist in those markets, you will appreciate. Very good examples would be Turkish market, which is very, very nuanced and requires a lot of knowledge about what's happening in Turkey and also the various elements there. South Africa is another good example where you really need intrinsically to understand the psychology and the collective psyche of the South African market. A little bit, then you compare it to say a euro against the dollar, the majors, where there it's actually more kind of formatted based on maybe lesser, smaller or more obvious parameters like Fed policy and US data. That will be pretty much your story. You will occasionally get a big merger or acquisition trade which has kind of fundamental large ticket size. UK would be a good example. They often have these big trades there which will have very short-term impact. Now, based on what I told you, if you're sitting in a market making in a bank, you need to know those. You're less concerned about it if you're sitting in a hedge fund because you have a certain drawdown limit. So you're obviously allowing yourself to lose a little bit, but fundamentally you believe in a position or in a direction. You may actually see these short-term elements as being beneficial as opportunity to buy the asset cheaper than what you originally bought it and add to your position. But as far as what traders use, it will depend on many, many factors. The actual markets they trade, the type of asset class, it's a whole encyclopedia, and different traders will tell you that different things. Okay, I have no understanding anymore about equity, but that will also equity will have certain macro conditions. If the expectations for interest rates are to go lower, then obviously you kind of think that the equity markets may go higher as a result. that is one generic, but individually you may say, well, you know, the chip market is very strong at the moment. So that's more important than even than you know, interest rate policy in the US. Okay, is there going to be a war in China and Taiwan, which will send, you know, silicon chip prices through the roof, and so people like Nvidia will go through the roof as well. Different parameters depending on asset classes. Obvious. I'm sure most people listening to this will agree, and will say, yeah, obvious, staying the obvious. But you know, it is what it is.
As a bank that provides liquidity, Danny, um, how would you describe the um, the battle of like, you know, of the what's the philosophy of the mental game behind the foreign exchange market? Because I think that's a question nobody can really address, because we're not exposed to the book. We don't see who enters the market and who exits the market, and we don't have
Yeah.
a DOM. We have literally nothing. The banks are only the ones who actually moves the market and moves the big capital in the world. So I would like to ask you how, like, the philosophy of the battle for the battle of mental game works in the foreign exchange market.
The foreign exchange market is combative, no question, and it's changed. It's evolved over the years because it used to be very much individuals and human beings, and now it's moved to more to algorithmic and systematic and platforms. So you know, platforms are trading. You know, computers are trading with each other. Still, like I said, the biggest market in the world, and it's still very popular with portfolio managers and hedge funds and etc. But fundamentally, the banks use, you know, if you look at Israel, for example, most of the pension funds don't see foreign exchange in its purest sense as an asset class. They see it as a function of what they're doing in other asset classes. So in order to buy US equity, you need to buy dollars. So you have immediately, and your policyholders are paid in shekels. So you have immediately an exposure between the dollar and shekel. And of course, exporters, importers, the same thing. Look, I don't want to say in the sense of, if you're an individual, foreign exchange, a guy sitting at home who wants to play markets, and if equities are not his game, then a lot of people will take positions, very small positions in foreign exchange, simply because there is a very strong and direct connection between macroeconomics globally and the performance of one currency against another. So somebody sitting at home with some basic economic skills, and I don't advise it, but this is what can be done. And also liquidity is the highest. I mean, there is no question, you know, of, like, if you trade equity markets, obviously there is a cap. Currency markets, it's unlimited. You know, you have access to liquidity, which is a major factor in getting liquidity. If you look at any portfolio manager, he doesn't, when he takes a position on it, he doesn't only look at entry liquidity, has to be obsessed with exit liquidity, because if he's getting in a position which he thinks, well, probably won't be able to get out of, what's the point? You know, you could be 2x up on a position, and then you try and sell it, and then suddenly there's no market for it. So it's important to know that. But fundamentally, FX is a very, very, very good characterization of macro opinion. Hence, that's why it's so popular. You know, yes, there are short-term, immediate, let's say, spikes or dips, which could be caused by commercial reasons, a merger, an acquisition, etc., etc. And obviously, you need to trade geopolitical in currencies like Israel. But on the whole, as I said about the euro dollar, the foreign exchange markets are a very strong characterization of macro performance. The previous governor of the Bank of Israel, Stanley Fischer, one of his maxims when he became the governor of the Bank of Israel, and people were talking about the overheating, the strength of the shekel at the time. It was a very big problem for the Israeli economy. He said, look, economy's doing well, shekel's doing well. It's a simple fact. And that's true. And by the way, it works the opposite. When an economy is doing very badly, then obviously the currency of that economy will also probably underperform. And so as the Israeli economy's done well, the shekel did very well. And as concerns over the economy and the war, etc., grew, the shekel did less well. That understanding, that ability to translate issues, fundamentals, and then use your understanding of that translation of what comes out in order to trade a particular market, and we're talking about FX, that is probably why it's so popular. You know, if you look at equity market, is specific to a company. It's very narrow. If you look at, by the way, the same is said about interest rate derivatives, but the difference with the interest rate derivatives and foreign exchange is the accessibility to the average guy of FX is complete, and in an interest rate derivative market, it's complicated and it's not as accessible. So hence, your average dude sitting at home, if he's not one of these people who are looking to buy and sell on the stock market, and he wants to kind of trade macro, kind of overall economic outlook that he has, FX is probably the easiest and most available and most liquid and probably the cheapest to do, because the spreads between the buyer and the seller are, you know, on that for that kind of person is very small.
Absolutely. Now I would like to ask you a bit of different question, not about the foreign exchange market. I would like to expand to other markets. So I would like to ask you how the foreign exchange impacts different markets, like the future markets, like the stock market. How it actually impacts, because you buy stocks with dollars, or you buy stocks with euro. It doesn't really matter. And I would like to ask you how the impactfulness of
Hey, you're
like the
looking at the
stock
wrong
market
way.
over the forex market, and
Yeah.
the forex
So
market over the stock market actually
okay.
works.
So I would flip that. I would say actually the foreign exchange market is the reaction. It doesn't result in it. I mean, you know, what would the forex market impact have on equity markets? I would struggle to really say there is much. But as I mentioned before about Israel, equity market causes a reaction in the foreign exchange market. So the foreign exchange market itself is, in my opinion, the reaction. You know, it's the cake. You put the ingredients in, it's the cake that comes out the oven. It's not the other way around. So it's how things, what happens in the world results in an FX reaction. One goes up, one goes down. It's not the other way around. Again, you understand that foreign exchange is two currents, it's like a
But
knife. You have two
can you
sides.
please explain a little bit more about the correlation between the markets? If one goes up and the other one will have to go down, like is
No,
there a
well, no, hold
correlation?
on. Again, it's people sometimes, especially young people when they're first learning the business, they think, oh, well, equity price, you know, IBM starts at $10 and it's $12, and it goes to $8 and it's $15. Foreign exchange is basically the relative weighting you give to currency A versus currency B. So if the dollar goes up significantly in against the shekel, it doesn't mean it's necessarily going up against the euro. If it's not going up against the euro, then clearly the euro will grow even higher against the shekel. So it's a weighting. It's a weighting based on demand, supply and demand. All the triggers that you mentioned create greater demand or greater supply, and that's how you get a price. How much am I willing to give you my dollars? How much are you willing to give me? At what level you want to give me your euros? And we exchange them. I will give you my dollars. You will give me your shekels at 368. $1 you'll give me 300. You know, $1 million I'll give you. You'll give me 3,680,000 shekel. The weighting that we will give, which is where the market is and the whole market. Remember, it's a global market. Is based on a number of parameters which we spoke about before. But it's not a case of, I think it's very important you understand, shekel currency trading is an opinion about a country. And that may be impacted by numerous things we spoke about, but it's not particularly about, like, you know, trying to compare it to equity trading or bond trading. It's slightly different. It's how I view currency A versus currency B. And that will be impacted by my opinion of country A versus country B, or what is going on in the world which may impact those two markets?
Danny, you know what? I would like to ask you. You know what? Let's go deeper within that conversation.
Dude, I just want to tell you, I've only got 5 minutes left.
All right, all right. So, you know what? Let's summarize. I just want to ask you last question before we go. Um, in day-to-day basis, how do the banks work and how do the foreign exchange work? Because there are some days like, there is literally no volatility, especially within the Asian session. But when you look at the overall the days overall, you see that most of the volatility happens during the New York and the London session. So I would like if you will be able to tell us the story of how the foreign exchange moves on a day-to-day basis.
Okay, it's got to be quick. All right, so first of all, volatility, there's two kinds of volatility, as you know. There's actual volatility, which is the underlying what's happening in the market. And when you trade volatility, you trade the implied volatility. And often there'll be a big difference. The difference being expectations of what's going to happen in the coming months as far as volatility is concerned, or the underlying asset class, as opposed to what is actually happening at the moment. So another example, again, I go back to Israel. Implied volatility trades much higher because there's a risk premium than actual volatility. They're very rare unless you have very, very low actual volatility. And in some cases, implieds will trade below because the actual vol is so low, and it's been low for a long period of time. So your concerns about volatility don't exist. It's irrelevant. You're not going to buy volatility implied. You trade the implied volatility because the underlying asset doesn't move. So, like if you look at equity, and a good example would be Coca-Cola, McDonald's on the equity S&P, they don't move. They just maybe, the underlying asset goes up slowly, but doesn't really move. Volatility is movement. So if a market goes just one way, up, or down, doesn't mean that means volatility will probably go down as well, because it's one direction. So the number of standard deviations will result in the actual volatility. So as far as how we look at it, how we trade it, okay, like I said, different people will have certain, nuances how they trade it. But on the whole, it all goes down to how we look at the global story, how we look at the various parameters, and how we believe they will impact, whether it's underlying markets or the volatility of markets, because they're both traded. Okay, that is it. It's quite simple. It's individuals, you will look at it differently. You're waiting. I mean, again, from your world, what you would do is take 30 parameters, okay, and ask a guy, 10 different guys, how much of a weighting from 100 would you give to the dots, the Fed dots? And different people have a different number, but they'll all be pretty high, but there'll be nuances. And then you'll say, okay, to the 30 guys, out of 100, how much would you give to unemployment data? And again, each one would probably be close, but it'd be different. And then you would say, you could go further and say, how much would you give to volatility, and different numbers for different people. And over a period of time, you would create a reality of where different traders have different views, and there would be some nuances, and you may actually get some differential, but all of them would apply some kind of weighting to most of those different questions. So you would get some correlation. You wouldn't be completely uncorrelated between the traders. You may get some nuances on the micro level.
All right. Daniel, I have to admit that this episode, I just shut my mouth up and I let you to speak, because each and every time you spoke, you have brought incredibly insightful lessons that I think they'll be extremely helpful and educative for each and everyone who eventually listen to the podcast. And I would like to thank you for your time and participation.
Thank you, Danny.
It
Pleasure.
was an incredible honor to have you here today, and we're so we're appreciative your presence within our podcast. So thank you, and we appreciate it.
Thanks, guys. God bless.
God bless you. Take care. Bye bye.